US stock markets remain in the green for the current week ahead of the highly anticipated US CPI print expected to hit the markets tomorrow, Thursday the 10th of November. The observed rally of all three major indices for the past few days has been supported by the recent shortcomings in the dollar, which edged lower mainly due to the uptick of the unemployment rate and the expectations of the market towards the US midterm elections. In this report, we aim to present the recent fundamental and economic news releases that impacted the US stock markets, look ahead at the upcoming events that could affect their performance, and conclude with a technical analysis. The Walt Disney Company, the communication services colossus, famous for its amusement theme parks across the world, as well as its online streaming platform, Disney+, was in the reds yesterday, closing the day at near the $100 mark. Disney is down by more than minus 36% on a year-to-year basis, while its 52-week trading range is between $90 and $177. Yesterday, in the aftermarket session, the company released its fourth-quarter earnings, with the results missing both revenue and EPS expectations, causing its share price to fall by more than 8%, and in today's pre-market session, its share price hovers around $92 level, pairing some losses. In regard to the figures released, Disney missed revenue projections by $1.3 billion in the fourth quarter, with the main culprit accounting for the miss being to direct-to-consumer and theatrical businesses division. More specifically, the division dragged down the headline figure due to the heavy strategic investments poured into the business segment, in an attempt to remain competitive, and is expected to yield fruitful results by the end of 2024, should global economic conditions allow it. Amusement parks once again saved the day, or the quarter if you prefer, which reported a jump of revenue in the vicinity of 70% alongside Disney Experiences and Products divisions, which also rose by 36%. As a result, the operating income for the entire segment accounted for a whopping 137% increase, indicating that clearly the parks are the main driver of the company's profitability, keeping the boat afloat. When it comes to the entertainment and the online streaming businesses Disney+, the company reported increases in subscriber accounts, with the company reporting strong subscription growth with the addition of 14.6 million total subscriptions, including 12.1 million Disney+ subscribers. Disney is set to launch its ad-supported subscription plans as early as December, and CEO Bob Chapek stated that a key component to our total property advertising portfolio and advertiser interest has been strong, pointing out that the company is expected to make up for the lost ground via advertisement deals with major players, but the impact will be more meaningful later in the fiscal year, added the company's CFO. Meta Platforms, the social media giant and digital work creator, famous for its metaverse project and social media network platform Facebook, came under significant pressure lately, following its anticlimactic earnings report for quarter 4 and more recently the announcement of mass layoff of its workforce. Meta was in the reds yesterday, closing the day around the $96 mark, and is down by an astonishing minus 70% on a year-to-year basis, while its 52-week trading range is between $88 and $353. During the past weekend, a Wall Street Journal report surfaced, stating that the company plans to lay off thousands of employees, and today, Wednesday, the implementation plan is to be put in motion. According to estimates, Meta's employees as of September were approximately 87,000, and layoffs are estimated to be the biggest since the inception of company, with the recruiting and business teams expected to be hit the most. In an open call, Mark Zuckerberg stated that the company will cut 11,000 jobs, just shy of 13% of its total workforce. He stated, "We're also taking a number of additional steps to become a leaner and more efficient company by cutting discretionary spending and extending our hiring freeze through quarter 1. I want to take accountability for this decision and of how we got here. I know this is tough for everyone, and I'm especially sorry to those impacted." The decision brought heavy criticism on the company's CEO, challenging his steadfast, aggressive approach at expanding Metaverse's strategy by spending excessively on the project, contributing negatively to the recent shortcomings. Thank you for watching.